Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back. Lovely weather out there. Just kidding. But it's lovely somewhere, I'm sure. And I guess it's okay depending on what you like. The kind of rainy, gray, but I'm just killing time here, folks. I'm just kidding. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. By the way, you can catch a copy of this on 95 The Fishes, our sister station. They actually own 1420. You can get a copy of the broadcast on the podcast unit there. You can also find it on iTunes. Just do a search for Bullington Capital. And you can find it on my website, bullingtoncapital.com. So, that being said, I'd like to kind of let you know what we're going to be talking about today, the kind of in segments. The first segment, we're going to be talking about the economy in general, various things we see happening and unfolding in financial markets. The second portion of it will actually, the second part of the break, we'll talk about the upcoming seminar that we're going to be doing and taking questions. The third part of the program, we're going to talk about the look out for the Bull website, which is, I know I've been saying this for a long time, but it'll actually be up by next Saturday. So that's been a long time coming, and it's been a tough one. And I think it's a pretty good time. A lot of what I'm seeing there and stuff that we'll be talking about in the last segment of today's program is working rather well, especially relative to a lot of other things. Stock market's doing well. That's not a unusual statement to make. This time of year, the first quarter has had a tendency in the past to be better than the other quarter. The first quarter and the last quarter of the year, generally the better quarters for the stock market. A lot of reasons why, and that may actually change over time. You never know. But anyway, I can kind of get it. A lot of firms that make their contributions to defined benefit pension plans make them in the first quarter. So you've got a lot of money coming into the stock market. Defined benefit pension plans and IRAs, 401ks, the people have a tendency now to max out earlier in the year. Once they've maxed out, then the contributions tend to slow down a little bit. So you've got this big gob of money coming into this market in the first quarter. And that's why it has a tendency to be one of the better performing, because there's just a lot of demand. What's been going on, too, over the past few years, the larger companies are receiving a much larger piece of that money. And it's because of the way the market is structured. I should say it's because of the way the mutual fund industry and exchange-traded fund industry is structured, and even the pensions. They have to buy the bigger companies, because these are, you've got billion-dollar funds out there. The last time I looked, there were over 4,000 funds with at least $1 billion in assets in them, which is really interesting because there are only 3,000 stocks for them to invest in. Think about that for a second. You got 3,000 companies, roughly 3,000, that these mutual funds can invest in, and there are 4,000 funds that have over $1 billion in them. That's the structural shift that I'm talking about, and it's caused some things to happen. A lot of companies that are good quality companies, they're high quality companies, are slightly overvalued. They're slightly overvalued. And they make up a large percentage of the average fund, especially in a retirement account. In a 401k, those are the types of stocks that those funds typically have to buy because they're managing so much money, they can't go into the smaller and medium-sized companies. So it's created a vacuum, so to speak. And I think it's opened an opportunity for people who are aware of it for over the next 3-4 years I really believe the smaller and medium-sized companies probably have a better shot of performing well. And I think the larger companies, unless they just keep going higher, and in that case, you would end up, that'll end up with a bang. Hopefully, we're going to avoid that scenario. I'd rather see them kind of go sideways and flat and have the small and medium-sized companies catch up. That's the way I would like to see it. It's a lot easier to take that way. The other alternative is that you have the larger companies who are slightly overpriced now, getting more overpriced, and then falling hard and fast. And I hope we can avoid that scenario. One of the other things I've seen over the past, probably 4 to 5 years, 3 years minimum, is that most momentum strategies have been underperforming, which is not uncommon. That is not uncommon for them to underperform for 4 or 5 years in a row, sometimes even longer, and then put in a couple of years where you wish you'd just kept the money you had invested in those types of strategies there. But here's the big but. Okay, the big but is, no pun intended, the market may have shifted, making that strategy much more difficult to perform as well in the future as it has in the past. It may have undergone a fundamental change. And what is that fundamental change? Well, you've got fewer stocks and much more money available to go after those fewer stocks. And the momentum strategies are not conducive to increasing returns on a huge fund. A fund that's over $1 billion in assets is not going to invest in momentum stocks. It can't. So, and I think that's probably a big part of the problem. And do I think that the shift will come back? I don't know. I really don't know. I don't know if momentum will ever be as effective in the future as it has been in the past. And not just because it's underperformed over the past 3 years, but it's underperformed for a reason. And in my mind, that reason is the institutionalization of the fund industry. When you're reading the papers, BlackRock, the largest manager, they actually manage more money than Fidelity does. They've undergone a massive change. They're laying people off. And they're doing more of the same thing that's worked over the past 3 to 4 years, which is basically by the large Procter & Gamble's, Apple, Google. You buy the large companies where they can, they're buying them based on liquidity, not necessarily the valuation, because it's hard to make an argument that those stocks are undervalued right now. And companies like Facebook, I believe, are overvalued, not by little. So, but you look at Facebook. Facebook's done very well. Well, why has it done well? Because it's a big company, and the way that these funds invest is they put more money in the bigger stocks and less money in the smaller stocks. And now there are more of them than there ever have been in the history of the industry. So I don't know if that's actually caused a change and a shift away from momentum-based strategies, or if it's just another lull in the cycle. So that's the $24 million question. Has it changed forever, or is it just a slightly longer cycle leading to an outperformance in the future? I don't know. I wish I knew the answer. So if I knew the answer, I could, I would be doing exactly whatever you needed to do. And what I'm going to do with that, because I do have a substantial portion of my own money and a lot of my investors, clients' money in momentum-based strategies, I'm going to offer alternatives because I don't know. And I also know, I'm pretty confident that there are a lot of stocks in the mid and small cap area that have not participated in this rally, companies that are generating lots of cash, whose valuations are extremely reasonable. That I know as well. That opportunity is there, and eventually that has a tendency to get recognized, and I don't even think it takes that long over time. That's a more value-oriented strategy. So 2 things happening. You've got a market that may have shifted fundamentally. The structure of the market has changed. And I don't know that momentum will be as effective in the future as it has been in the past, which is okay because you've got this opportunity waiting there that you can actually make a change to. And one of a few things is going to happen. If I stay where I'm at and I have a much larger percentage of my portfolio allocated to momentum than I think I'm going to have in the future, actually than I know I'm going to have in the future. If I stay where I'm at and momentum does come back in favor, then I'll probably wish I had stayed put. If I'm correct and the market has shifted fundamentally and momentum's not going to be as effective, I'll still have a small portion of my money in there. And for the fewer time periods that it does outperform, I'll be glad that I left that money in there. In the meantime, I've got this other strategy that's getting the most profitable stocks in their categories that haven't really participated in this move. When their time comes, that could really, really help the performance of the overall portfolio. Kind of a interesting quandary. So if you stay put and momentum does come back in favor, you close the performance gap lickety split and you're ahead of the game. If it doesn't, and you've reduced your exposure to momentum and you've replaced it with this other value-oriented model that goes into small, medium, and large stocks, by the way, instead of just large companies. And that does as well as I think it can because of the opportunity that exists today. Then we're going, woohoo, close the gap, back in business. If, let me see, the other alternative is to eliminate momentum completely from the portfolio and just use the value-oriented stuff. I have a dividend model, and it's just like most of the large cap. It's all large companies. It relies heavily on the dividend. It's outperformed it's in the top 10% of all funds, especially over the past 3 and 5 years. And that's just showing, that's an example, an illustration of exactly what I'm talking about. So I use more than one momentum strategy. And when you compare all the momentum strategies to one another, they're all within a couple percentage points of each other. And then you look at the more evaluated large company stuff, like the high dividend models, or even a Russell 1000 ETF. Those have done better over the past 3 or 4 years. You go back further, and the momentum model is actually still ahead. But that being said, it's a very tough situation to sit there and watch a strategy languish when another one's working really well. And unfortunately, in order to capture the shift between those strategies, you have to have a crystal ball that works. And I do not. I do have a crystal ball. It just doesn't work. If you come to my office, I literally have a crystal ball. It's really cool. Very pretty. We're looking at that thing all the time. Hasn't helped me in one bit. Anyway. So and I really want to talk a lot about the newer model that I've rolled out. I've actually begun to roll it out. And a couple days ago, I decided to add a couple of variations. Same basic formula, but you can hold a larger number of stocks depending on how aggressive or how conservative you want to be. But you're picking the stocks the same way. You're just holding a larger group of them if you want to be more conservative to get more diversification. And if you want to be more aggressive, you just hold fewer of them, but you're using the same formula. And the formula is, I'll just tell you what it is. It's operating income divided by the enterprise value. And we're going to be talking about that specifically at the next workshop because you can custom tailor this to your personal needs. And this is a big deal. You can custom tailor that to your needs and your personality. Personality has a lot to do with your investment success, believe it or not. Your appetite for risk has a tremendous amount to do with your success in investing. Yeah, if you're very conservative, today's environment, very difficult to make a lot of money because you've got CDs and other interest rates that are very, very low. Now, the creeping up a little bit, but it's still not enough to be able to retire on unless you're a multimillionaire. Okay, so if you're conservative, there are some things that you should do to be able to make yourself or put yourself in a position to earn better returns than you're going to get in CDs. And that's kind of an important thing. How do you evaluate that? I've got a very simple formula I'm going to show you at the workshop. And now that I said that, I forgot which date that I had put it up. So I'll just pull it up here on my computer really quickly. You know what's amazing? I'm hooked up through my cell phone to the internet because it's all encrypted and all that. It's safer. And I just pulled that up. It pulled up lickety-split. That's unbelievable. Anyway, the next seminar is May 11th. It's going to be 7 o'clock. You can go to the website, bullingtoncapital.com, to find it online. There's no cost to attend. Seating's limited. We have 82 seats remaining. We typically cut them off at right around 100. The facility holds 120, so everybody's not sitting shoulder to shoulder. But and it's a very good time. Again, you go to bullingtoncapital.com. Just click on the seminar link. It'll tell you all about it. It's I'm calling it the key to successful investing. Choosing an investment strategy that suits you. You know, that is so important, and it's kind of a hard thing to do. It's hard to determine what kind of investor you are. Now, through the seminars, we discuss the different types of investors in the market. In my opinion, there are two extremes, and then there are lots of shades between those two. So there's 50 shades of gray. There's actually about 1,000 shades of investors. Some of them, the difference is like not so much. But you will hopefully come away from that having a pretty good idea. I'm going to give everybody a worksheet. We're going to fill it out. It's not extremely long or complicated. I don't think it needs to be. Actually, it's kind of fun. You get to determine what kind of a risk taker you are, and then how you should go about investing in your portfolios based on the information you get from that workshop. You'll pretty much know how to judge what type of funds and what type of mix you should have in your portfolio. The mix between stocks, bonds, and cash. Now, there are only a handful of things that you can invest in, by the way. And now that I hear the music, that means I have to take a real quick commercial break. So we'll talk about that when we come back. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, you know what? I just thought of something. Make sure you tune in to the last 20 minutes of today's show, because the momentum stuff that the Lookout for the Bull website is going to talk about, the trend following, there's some companies that have come up on some of those scans I'm going to talk about specifically that I'm going to be adding to my account this week. I run a small, it's only about $1 million, and that's small in the investment business. That's not a lot of money. So I run about $1 million using the exact techniques that we'll be talking about in the last section of this show today. And I think that portion of the show will be up on the iTunes. So if you are listening to it and we put it up there, you want to go to the last 20 minutes of it, because it's very interesting. I think it's rare that you get companies with the combination of low valuation and rapid price movement coming together. And it's actually the first time I've seen this in a few weeks now. So it's kind of exciting to me anyway. So make sure that you listen to the last portion of this show. And if you're listening to this on the internet and that's what you were looking for, just fast forward to it. So, because I think it'll be worth your while. Anyway, we're talking a little bit about, we'll start off the show talking about how there's probably a fundamental shift, that a broad-based momentum, when you're trying to do it over a large number of securities and a large asset pool, it's actually underperformed now. It's actually about 3 years. It's been 3 years since it's put in a really good performance. That is not uncommon. That's not uncommon. That's happened many times in the history of the stock market, where that particular style has gone out of favor. The styles that have been in favor are dividend and large value in particular. And now a lot of those stocks are not as inexpensive as they once were, and many of them are slightly overpriced, which opens up an opportunity. Now, the money may flow back into momentum, but then again, it may not. It may flow into those stocks whose valuations are attractive. Okay, and I've got a little formula I'm going to put out. It's relatively simple. I'm looking at the earnings before interest and taxes. A lot of people equate that to operating income. They're not exactly the same thing, but they're extremely close. So an operating income is the income a company's generated before they pay interest or taxes from their normal business operations. It's the salaries, the administrative expenses, the cost of the goods. You add that stuff together, you subtract it out, and it's the gross profit before interest and taxes. Now, excuse me for all the CPAs out there. I know I'm leaving a couple things out, but this is the radio, and I can't really go into great detail without putting everybody to sleep. So, I'm going to leave it at this. If you don't have operating income, you really don't have a business. You have a business plan. Hopefully, the business plan turns out and you make some money one day. In the meantime, I'd rather take a look at that measure. That's one measure of how profitable a company might be. And I'm going to divide that by the price of the entire enterprise, or they call it enterprise value. So when I do that, now I've converted a company into a yield that I can compare one company to another company on. Why do I want to do that? Well, because wouldn't you like to own the companies that would, if you were buying the entire business, would give you the highest returns on your investment? Absolutely, right? That's it. So again, we're going to talk about this probably at every workshop for at least 10 minutes going forward. You can find out when the next workshop is just by going to my website. It's bullingtoncapital.com. And the next one is May 11th. That's a Thursday night, 7 o'clock, Corporate College. Just check it out online. If you want to show up, there's no cost to attend. We've got about 82 seats left. So it should be a lot of fun. And I think I tried to cover this last time. I got off on too many other topics. I felt like I didn't cover it as well as I should. And I'm going to keep covering it over and over again because it really takes more than one time hearing something like this to be able to get the full understanding of what we're doing. Unless you do like I do and you just sit there and study it until you got it. And even then, certain things will come up later on. For example, I didn't think about this when I was first reading about the formula, which is pretty common, quite frankly, in institutional terms. But I really didn't think about what it was actually doing. I'm going to divide the operating income or the earnings before interest and taxes by the cost of buying the business. Now, why am I doing that? Well, because I want to figure out how much money I'm going to make if I buy if I bought the whole business. How much money would I be getting? And I know a lot of people out there, I can hear you right now driving around going, well, I'm not going to be buying the whole business. I'm only going to be buying some shares. Yeah, well, you should act like you're buying the whole business because you don't really want to buy a single share if you wouldn't buy the whole business. Unless you're a trend follower and you're not really that concerned about that. Okay, that's a different animal altogether. But if you're an investor, if you want to make long-term investments, this is what you need to know. These are the types of things that Warren Buffett is looking at. When Warren Buffett buys a business, he wants to know how much money he's going to make if he buys that business. And that's going to be dependent upon how much he pays for the business relative to the amount of cash that business is generating. Relatively simple. I'm just going to show you how you can do it in everyday terms. Now, this is what I'm doing with it. I'm taking this material, which, again, I'll be presenting at the workshop. Go to bullingtoncapital.com to sign up. It's free. Feel free to call me and set up an appointment. If you're an investor who's thinking about investing, I'll talk to you on the phone. I'll even meet with you. I'll show you what I'm doing. No big deal. No pressure. We don't have time to pressure anybody. By the way, it's hard enough for me to call back the people that want to talk to me. So feel free. You can email us. You can set up a phone meeting. It's not a big deal. This is a very important thing to understand. Let's say I've got company A. I'm getting back to what I was alluding to just a couple minutes ago. Some of the nuances that aren't completely apparent at first. I didn't even think about it. I was looking at it and going, oh, okay, I get it. And then later on, somebody was asking me about, well, what about the debt? What if a company has a lot of debt? Well, what's interesting about that formula is it penalizes companies who have debt. It makes them, it's a requirement that they're going to generate more cash. And let me tell you what I mean by that. Let's say company A has a market value of their stock of $1 billion. It's $1 billion company when they've got, 100 million shares and it's $10 a share. Okay, so it's $1 billion. The market value is $1 billion. And that company generated an operating income last year of $100 million. Okay? So 100 million divided by $1 billion is 10%. Okay? 10%. So if I bought that company and I only looked at the value of the stock that I would have to purchase if I bought all the stock, okay, that's called market capitalization. I'm making 10% on that purchase, okay? That's assuming that this company doesn't have any debt, incidentally. So if company B has also $1 billion market value of their stock, also made $100 million, it's 10%, right? But company B does have debt, and company B has debt of $1 billion. So company B, for me to buy all of company B, I'm going to have to buy the stock and I'm going to have to pay off the debt. That's called enterprise value. Now, I'll get back the cash. And again, you have to forgive me for leaving out some really tiny nuances there. If you're a CPA out there, I know it. I know what they are. Yeah, but again, this is a radio, and I can't go into that great a detail. If you want to make an appointment with me to debate this stuff, no problem. Yeah. Anyway, for our purposes, enterprise value, the cost of buying the entire business is you have to pay for all the stock and you have to assume the debt. You get back the cash. So basically, it's what you're going to pay out of pocket. So let's assume company B has $1 billion in debt, no cash, and $1 billion market value. So you'd actually be paying $2 billion for it. Now, all of a sudden, the $2 billion cost of enterprise value, getting $100 million a year is only a 5% return. And that is what's really fascinating about this super simple formula. Because when I include the enterprise value, all the cost of buying the entire business, instead of just what the stock is selling for, okay, now I see what Warren Buffett sees. And anybody like him, all the private equity firms that are out there, there are a ton of them. Okay. That's what they're looking for. They know that company B is only going to produce is only producing currently a 5% return because 100 million on 2 billion is 5%. Company A suddenly looks a lot better, right? Because it had no debt, selling for $1 billion, made $100 million. It's earning 10%. And the question is, would you rather have 10% or would you rather have 5%? Not a trick question. That's a very straightforward question. What would you rather have, 10% or would you rather have 5%? And that's really all there is. Well, I shouldn't say that's all there is. There's a lot of other little nuances like that in that very simple formula. That's what I really like about that thing. It's got a ton of little tiny nuances in there that I won't bore you to death with anymore in today's program. I'll pick out another one next week and cover it. But it's got all these little things that makes adjustments when people are normally asking about adjustment. Well, how much debt do they have? Well, how about the preferred stock? And all that stuff is taken into account in that formula. And again, we'll come back to a lot of that stuff on future programs. Feel free to call or email with questions regarding that sort of thing. But I think it's a really good way of going through and picking stocks, especially if you're going to put a whole portfolio together. Do you want the 50 stocks that have the best returns? Or do you want the 500? The top 50 generally going to do better than the top 500. Now, the top 50 are probably going to be a little more volatile than the top 500 because you've only got 50 stocks. I'm holding 30. I took the top 30 because I'm a little bit greedy. No, I'm just kidding. I'm actually willing to put up with the higher volatility to shoot for the higher returns. But that's me. That's my investment personality. I'm willing to take a calculated risk to try to achieve higher than average returns. That's Bill Bullington. That is not a lot of my clients. In fact, a lot of my clients are extremely risk averse. So we're doing different things in their accounts. Why? Because when the going gets rough, if they were doing the same thing I'm doing and their portfolio is down, 30 or 40%, which I'm prepared to be down by, have been down by in the past, they may not stick around until it comes back. And that's a problem. That's a problem for everybody. It'll affect your lifestyle. If you're taking more risk than you think you are, that could be a problem. You're not going to find out until until the market crashes, and then you realize you were taking more risk than you knew you were. And there's a really simple way of figuring out approximately how risky your portfolio is. It is incredibly simple. And we're going to talk about that at the seminar. It only takes about 10 minutes to go through it. Unfortunately, there's a slide with a little bit of math on it, so I can't do that on the radio. But I am willing to do that in person. If you'd like to set up an appointment, again, just feel free to contact us through email or call us. Not a big deal. I do it all the time. And one of the reasons I can do that, by the way, is the methods that I use for picking companies to be in a portfolio, to even the asset allocation portion of it, they're basically based on math, logic, and experience. Math, logic, and experience. Not that hard to do for somebody that's been doing it for a very long time. If you've been doing it as long as I have, you're probably at least as good as I am, maybe better. You don't know. Don't know what your aptitude is or your appetite for risk and all kinds of things. But anybody can learn it. That's the other thing. Anybody can learn it. You're not hearing it on other sources of media. In fact, hats off to WHK and Wholesalem, because they make stuff like this available. And it's a big help to a tremendous number of people. Anyway, so by the way, you can call us today, 216-901-0945, if you have a question, 216-901-0945. And the last segment of the program, we're only a couple minutes away from the next commercial break, but the last segment, we're going to talk about the trend following method of managing money. There are lots of different methods. This just happens to be one of them. It's one that I like. It's one that's not 100% math. It's 95% math. And the other 5% is literally, I just buy what I like. I literally buy what I like from the list of stocks that meets all the mathematical requirements. And I can show you how to do it. In fact, I will be showing you how to do it. Look out for the Bull website. It's going to be up. And I think it's hilarious. The training section, if it takes you more than an hour to read through the whole thing, it's because you're goofing around or you have kids. One of the two. And, you know what I forgot? Oh, man, I can't believe it. I forgot to talk about fixed income. Fixed income with rising interest rates. I've got a quick commercial break, or a commercial break soon, so I got to do this pretty quickly. Don't be buying anything that has an average maturity of more than 5 years. If you have an average maturity, if the bonds in your funds or the bonds in your portfolio are more than 5 years, I think you might be sorry. Because when interest rates go up, bond prices come down. You may end up having to hold those bonds until they actually mature. And if you're in a fund, the bond fund manager is going to sell them at a loss. Okay? So don't be holding on to funds or individual securities who have maturities of longer than 5 years. Now, I know what you're thinking. A 5-year CD doesn't pay very much. A 5-year treasury doesn't pay very much. No, they don't. I have an alternative. They're called high yield bond funds. And I promise I'll finish this thought right after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. I'll be right back. Right. Now we are at my favorite portion of the show. I love talking about trend following. It's fun. It can be very profitable, But before I do that, I promised I was going to finish that last thought, and this time I'm actually going to do it. I normally don't do it because I'm mean like that. I do it because I forget. I'm talking about so many things, and so many ideas are going through my head that I lose track. So this time I remembered. We were talking about high-yield bonds. Well, you didn't know that I was talking about it. I was talking about investing in bonds, and I was recommending that you go less than 5 years. Because if interest rates are rising, long-term bond prices tend to drop. So you don't want to be in bond prices that are going down, and they can go down quite a bit, in fact. So I would stick with funds who have less than a 5-year maturity, less than 5 years. You don't want to look at the, what do they call that? I forget. There's a number that they like to use. Oh, the effective duration. Forget that. Forget that. Look at the weighted average maturity. Find that out. If it's more than 5 years, skip that fund. Skip it. Because something that's got an average maturity of more than 5 years is going to go down when interest rates go up. If they keep raising interest rates, that's just going to kind of slough off. And actually, if it's a super long-term bond fund, it'll drop pretty sharply. So 5 years or less, that's what you want to stick to. And I'll show you some of the things that I'm using at the seminar if you want to get there. If you want to call about this, one of the keys of the fixed income models I run is I use high yield bonds. The high yield bond, the fund that I'm using has an average maturity of a little over 4 years. It's got an average yield of a little over 5%. It has a tendency to move more in line with the stock market than it does the bond market. So if stocks are going higher, it's typically going higher too. Beautiful thing, as far as I'm concerned. Can't guarantee anything, but probabilities are that's going to do better than your average bond fund going forward. Having said that, I forgot to give out the telephone number in the past 20 minutes or so, 216-901-0945. If you have any questions, 216-901-0945. I'm going to go right to Jerry. Jerry, how you doing?
Hi, Bill. I have a couple of very basic questions for you.
Sure.
Well, how does open interest versus volume, how are those two terms described? What's the difference between them?
Open interest are the number of contracts that are outstanding on a particular option, and volume means the number of transactions that have accrued for whatever time period they're looking at. It could be 1 day, it could be a week, a month, and you have to find out what what period they're looking at when they publish that. And I've seen different vendors do it different ways. Mm-hmm. So just to make it more confusing. No.
Now, but you say now, open interest is the volume of calls or puts that are out there currently. Is that correct?
That's actually not what I said.
Okay, please say it again.
That's interesting that you would take that from me.
Well, I'm trying to, it's kind of confusing to me, so I'm trying to.
I know, and one of the problems I think with the financial services industry is that they have their own language.
Okay.
And there are actually sub-languages within the languages that are as at least complex as the overall language. So when you're looking at options, when you're looking at the open interest,
yes,
that's how many contracts have been created. So let's say you've got an open interest of 1 million on XYZ company, and it's going to expire next month, the third Thursday in the month, or the third Friday in a month. That is, so there might be 1 million contracts that people have entered into where you've got a buyer and a seller.
Okay.
That are still outstanding. Those are all going to expire next month.
Okay. So those will expire.
Yeah. Now, on a daily basis, they may the people that are owning those contracts may be buying and selling those contracts, and other people may be coming in, buying from somebody who already has a contract. When there's an increase in demand or a increase in supply, that open interest number will actually change.
Okay.
And the volume is actually going to have an impact on the open interest, depending on how aggressive or conservative the buyers are supposed to be. I know that's as clear as mud.
Well, what can be gained from that? I mean, say if the volume...
Almost nothing.
Okay. Well, that's really what makes any difference
Yes.
to me. So nothing can really be gained from it anyway, from a definitive standpoint. How about implied volatility? What does that mean?
Well, implied volatility is a measure of how that stock is trading, how the option is trading. If the implied volatility is very large, it means the expectations of the people that are trading those options is that there's going to be a big move, and it's typically a result of an increase in both volume and open interest.
Okay.
So those have an impact on that. When the implied let's say a stock's typically up or down 2 or 3% a month.
Okay.
That's its average. Okay.
Right.
That would be the actual volatility.
Okay.
If the option premium is set to the point, let's say the stock's at $50.
Right.
Okay. And 3% of 50 is
15.
Right. So if it's more than 1.5% or $1.50.
1.5.
Yeah. If it's more than $1.50, you would say that the implied let's say the implied volatility is 3. Well, the actual volatility is only 150. Okay, so somebody's expecting that stock is going to make an announcement that's going to drive the price higher than its average volatility.
Yeah.
So the implied volatility is that, hey, they're probably expecting a big move here. And oftentimes people look for that because people on the inside, even though it's technically illegal, they often will trade.
Sure.
Or if there's just a big expectation by a big hedge fund that, we think this quarter is going to be a really good one. We've been talking to their suppliers, but then they've been doing all the groundwork, all the research, and they think it's going to be a big month. They may go into the options market instead of just buying the stock.
Buying the stock itself. Okay. So the implied volatility, say I'm going to use your terminology. Say if your stock's at a $50 stock and it's moving up an average of 3% a month, then you're going to take the 3% times 50, get about a 1.5 implied volatility. Is that correct?
No, that's the actual volatility. The implied volatility. Yeah. So if
actual.
Yeah.
Okay.
And by the way, that calculation, you can look it up online. You got about 80% of it. The calculation is looking at the volatility over an entire year.
Okay.
And then it's taking a standard deviation. It's just the Black-Scholes model. Just you Google it. The math is kind of it's relatively difficult for somebody who hasn't studied it for a long time.
Right.
Heck, it's still difficult for me, and I just don't do a lot of effort or work in that anymore, because what you're going to find out is that the implied volatilities are oftentimes wrong. The things don't work out like people thought they were going to. So if you paid $6 when you should have only paid $3 because you thought that it was going to explode up to $60 or $70, over the next 3 months, then you overpaid. Mm-hmm. And what's really rough is when the stock goes from 50 to 53. So the actual volatility was correct, but you paid $6.
Well, yeah, sure. Okay. So as far as factoring in, what is a high implied volatility rating? Does it say over 5? Is that? No,
it depends on the stock. The stock's own volatility is going to have a big impact on that.
Oh, say for example, we'll give you a name like.
No, can't do that, dude. Because those change for every single month.
Every one it changes,
yes.
So it's not really a fixed in the.
No.
Okay, very good. Last question I had was mentioned. Most recently, Vulcan Materials, which has been in the building sector, or it is in the building sectors, but it hasn't been getting the movement that some of the other companies have. Do you have any thoughts on that or followed it at all?
Well, the chart doesn't look all that promising. Mm-hmm. That can change, and probably it will change over time because it's a stock. But it's not as strong looking as a lot of others. Now, if I go back to an extremely long chart, I just took a monthly chart here. It's just slightly below where it was in 2007.
Right. That's why I think I have some.
Yeah, but as far as a building materials product company, you want to talk about an incredibly difficult to make projections for, because there are so many variables in a commodities type of industry like that could pop up at any time. So your guess is as good as anybody's.
Okay. So very good. And I guess that'll do it for me this morning.
All right. Well, hey, thanks for calling. Have a good weekend.
Thank you, Bill. You too. Bye.
Bye-bye. Yeah. So don't worry if that conversation didn't make a lot of sense to you. It doesn't really need to. The stock market can be incredibly complicated if you want it to be. You can also reduce the level of complication the way that I've tried to do over my entire career. And I'll give an example. So this website, Look Out for the Bull, it's coming up. It'll be actually next Saturday, it'll be up and functional. One of the things I've noticed through the years, actually I've learned from other people and been able to verify, is that a stock that's outperforming the vast majority of them, has a tendency to continue outperforming, particularly if it has met certain criteria. Okay, the criteria I don't have time to go into in great detail today. Actually, geez, I can't believe it. I spent all that time on the question. I really apologize. I will cover this again. I'll actually start next week's show by covering this material. It's very important for people that want to try to do some trend following. Anyway, you've been listening to Bill Bullington. Thanks again for listening. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good weekend, good luck, and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.